Welcome to Money and Markets Series 3, Lesson 2. In Lesson 1, you learned how to price a bond. You took a stream of future cash flows, discounted each one back to today, and added them up. But now, flip the question. You walk into a market and you see a bond trading at a specific price. You know the coupon. You know the maturity. What you do not know is the return you are actually getting. That number is called the yield to maturity. It is the single discount rate that makes the present value of all future cash flows equal to the price you pay today. And once you can calculate yield, you can compare any two bonds on equal footing. Government versus corporate. Short-term versus long-term. Safe versus risky. This lesson builds that tool and then uses it to explain why some bonds pay more than others. Start with the simplest possible case. A bond with a face value of $1,000, a coupon rate of 4%, and 4 years to maturity. The price? Exactly $1,000. 4% of $1,000 gives you $40 a year in coupons. And at the end of year 4, you get the final $40 coupon plus your $1,000 back. Now, what is the yield to maturity? Think about it. You paid exactly face value. You receive exactly the coupon rate on that face value. There is no capital gain and no capital loss. The yield to maturity equals the coupon rate. For percent, this is the at-par case. Whenever a bond trades at exactly its face value, the yield equals the coupon. It is the baseline, the reference point. Every other scenario is a deviation from this one. Now change one number. Same bond. 4% coupon, 4 years, $1,000 face value. But the market price is $950, not $1,000. You still get the same $40 a year in coupons. And you still get $1,000 back at maturity. But you only paid $950. That means at maturity you pocket a $50 capital gain on top of the coupons. So your total return is higher than 4%. How much higher? The yield to maturity for this bond is 5.424%. That is the discount rate that makes the present value of all 4 coupons plus the final principal payment equal to exactly $950. Here is the intuition. When you buy below face value, you earn the coupon rate plus a bonus from the price discount. The deeper the discount, the higher the yield. And it works the other way too. If you pay more than face value, the yield drops below the coupon rate because you absorb a capital loss at maturity. Now here is the catch. You cannot solve for yield to maturity by simple algebra. Look at the equation. The price equals 40 divided by 1 plus y, plus 40 divided by 1 plus y squared, plus 40 divided by 1 plus y cubed, plus 1040 divided by 1 plus y to the 4th. You are solving for y, but y appears in every denominator, raised to a different power. There is no convenient closed-form solution. The equation is nonlinear. So how do you find it? Trial and error. Systematically, you guess a rate. You compute the price. If the price is too high, your guess was too low. If the price is too low, your guess was too high. You adjust and repeat until the price matches. In practice, a spreadsheet does this instantly. The goal-seek function in Excel, or the yield function, converges on the answer in milliseconds. The concept matters more than the mechanics. Yield to maturity is defined by an equation you solve numerically, not algebraically. Most bonds issued in the United States pay coupons twice a year, semi-annual. This changes the math slightly, but the principle is identical. Take the annual coupon rate and divide by 2. Take the number of years and multiply by 2. Now you have twice as many cash flows, each half the size. A 4% annual coupon on a $1,000 bond becomes $20 every 6 months, instead of $40 once a year. Over 4 years, that is 8 payments instead of 4, plus the principal at the end. The yield to maturity is still defined the same way. Find the rate that makes the present value of all cash flows equal to the price. But now the rate is a semi-annual rate. To annualize it, you multiply by 2. This convention is standard across U.S. Treasuries, corporate bonds, and most fixed income products. When someone quotes a yield in the bond market, it is almost always a semi-annual yield, doubled. Now strip away the coupons entirely. A zero-coupon bond pays nothing along the way. No $40 a year. No $20 every 6 months. Nothing. You pay a discounted price today and receive the face value at maturity. One cash flow. That is it. Here is an example. You pay $630 today, and in 10 years you receive $1,000. No other payments in between. What is the yield? It comes directly from the present value formula. 630 equals 1,000 divided by 1 plus y, raised to the 10th power. Rearrange and you get y equals 1,000 over 630, raised to the 1/10th power minus 1. That gives you roughly 4.74% per year. Zero-coupon bonds are the purest expression of a discount rate. No reinvestment complications. No coupon timing. Just one price today, one payment later, and the implied rate that connects them. If zero-coupon bonds trade at different maturities, each one gives you a discount factor. A price for $1 delivered at that specific date. A 1-year zero priced at $961 tells you the market values $1 in 1 year at about 96 cents today. A 2-year zero priced at $918 gives you a different discount factor. And so on for 5 years, 10 years, 30 years. String them all together and you get the zero-coupon yield curve. This is the same spot curve you saw in Series 1, but now you are seeing where it comes from. It is built from real traded prices of zero-coupon instruments. Why does this matter? Because the zero curve is the foundation. Once you have it, you can price any bond. Any coupon bond is just a bundle of zero-coupon payments. Discount each cash flow using the matching spot rate, add them up, and you have the fair price. The zero curve is the skeleton underneath every bond price in the market. Now, why do some bonds yield more than others? Start with government bonds. A U.S. Treasury is backed by the full faith and credit of the federal government. The chance of default is treated as essentially zero. So the yield on a Treasury reflects only the time value of money and expected inflation. It is the risk-free rate. The floor. Corporate bonds are different. A company can go bankrupt, can miss payments, can restructure its debt. There is real credit risk. To compensate investors for that risk, corporate bonds must offer a higher yield than treasuries of the same maturity. The difference is called the credit spread. If a 5-year treasury yields 3% and a 5-year corporate bond from a strong company yields 4.2%, the credit spread is 1.2%, or 120 basis points. 100 basis points equals 1%. The wider the spread, the more risk the market sees. Investment-grade companies might trade at 50 to 200 basis points over treasuries. High-yield bonds, sometimes called junk bonds, can trade at 400, 600, or even 1,000 basis points over. Credit spreads are not just academic. They are alive. They move every day. When the economy is strong and confidence is high, spreads tighten. Investors feel safe lending to corporations, so they accept smaller premiums. Corporate bond prices rise. When fear enters the market, spreads widen. Investors demand more compensation for the same risk. Corporate bond prices fall, even if the company itself has not changed. This is why credit spreads are one of the best real-time indicators of economic health. Widening spreads often signal trouble before stock markets react. Every mortgage rate, every corporate borrowing decision, Every government funding cost traces back to these two pieces. The risk-free rate, set by the government bond market, and the credit spread, set by investors pricing the probability of default. Understanding yield to maturity and credit spreads does not just help you read bond prices. It helps you read the economy. For takeaways from this lesson: 1. Yield to maturity is the single discount rate that equates a bond's price to the present value of its cash flows. When a bond trades at par, yield equals the coupon. Below par, yield exceeds the coupon. Above par, yield is less. 2. You cannot solve for yield algebraically. It requires numerical methods. The equation is nonlinear, and that is fine. Spreadsheets solve it instantly. 3. Zero-coupon bonds are the purest yield instruments. Each one gives you a single discount factor. String them together and you build the spot curve that underpins all bond pricing. 4. Credit spreads are the market's price for default risk. Government yields are the floor. Corporate yields sit above, and the gap tells you how much risk investors see. In the next lesson, we leave pricing behind and ask a different question. Who actually buys and sells these bonds? What does the market look like from the inside? That is lesson 3. Buy side, sell side, and the bid-ask spread.